OptionChampion.com.
Today is Saturday, April 22nd. I'm Rick Adams, and this is Tricks of the Trade.
All data and other information contained throughout this video are for demonstration purposes only and shall not be construed as trading or investment advice or an advertisement for software or other trading applications. Nor shall any part of this presentation be considered a recommendation of securities or other tradable products or related strategies. Trading and investing, whether short or long term, involve risks that may not be suitable for everyone. Any mention of past performance is not an indication nor a guarantee of future results, as volatile market conditions can arise at any time and result in substantial losses. No individual should make any trading or investment decisions without consulting a professional and conducting his or her own research.
Welcome to Tricks of the Trade. On this Saturday, equity options are now off the board for the month of April, putting the May options in the front month cycle. Cash market indices ended the week mostly lower. The Dow lost 77.5 points. The S&P 500 lost 4. The NASDAQ Composite lost 50. The Russell gained 10, and volatility came in by 30 cents. Crude oil lost $4.72 on the week. Gold lost $23.60. Silver lost 31 cents, and natural gas ended the week higher by 11 cents. One of the latest positions was a naked short put in Coinbase, ticker COIN. Intraday, the stock was down $2.96 at $64.30 per share, and the May options had an implied volatility of 105%. So it was the perfect opportunity to take a bullish position with a short put in the event of volatility contraction from a reverse move to the upside. At the time of the trade, the average price range over the previous 50 days was $6.25. The maximum price range was $15.64. The average price change was $3.03. The stock is known to move $15 to $20 per share in a single day, so I had to be careful in selecting my strike. I didn't want to put the position on at a strike too close to the stock price and risk being stuck with an in-the-money short put if the stock price fell sharply below the strike. So I went $19 out of the money and sold the 45 put in May with 30 days to expiration, collecting a credit of $1.52 on the trade. Later on in the day, the stock rebounded off of its lows to $65.75 per share, and the May implied volatility had fallen from 105% to 99.5%. So I closed the position out for $1.18, earning a nice little profit of 34 cents per share. There were a couple of zero DTE trades where options were traded on their day of expiration. One of the trades was in Apple, ticker AAPL. Shortly after the opening bell on Friday, Apple fell from a high of 166.46 to a low of 164.72. Expecting the stock to bounce up off of that low, I bought the 155 call. At the time of the trade, the stock was priced at $164.88, and the 155 call had $9.88 of intrinsic value. That's the difference between the call option strike price and the stock price, meaning the call option was worth $9.88. I bought the 155 call for $9.90, paying just 2 cents above its intrinsic value. Apple stock price rose from $164.88 to $165.50, and I sold the 155 call at $10.15 for a small profit of 25 cents per share. The second zero DTE trade was in SPY, the S&P 500 ETF, also shortly after the opening bell. SPY had rallied from a low of 410.44 to a high of 412.44. The stock price pulled back to $412.18 and I bought the 415 put for $2.92, just 10 cents more than its intrinsic value of $2.82. As the stock price continued to fall to $411.89, I sold the 415 put at $3.15 for a small profit of 23 cents per share. Those were a couple of nice little scalp trades. That's it for this episode of Tricks of the Trade. I'm Rick Adams. Thank you very much for watching. See you next time.